Hello and welcome to this week's video insight. In a world full of many shades of grey, using absolutes, words like never, always and none, can limit your thinking and actions. This can skew you to cognitive biases and obscure considering out-of-the-box thinking. Despite this, it is easy to resort to and too often used by investors. Today, I wanted to play devil's advocate and offer an argument to challenge the phrase, "I will never buy above valuation." I'm going to discuss 3 circumstances where it makes sense to buy above intrinsic value, one for quants, one for the value investors, and one for the mathematicians. For the quants, I want to talk about momentum. Now, whilst at Montgomery we focus on quality and value investing, it is well known that an alternative strategy is to purchase stocks with a strong momentum. Momentum in cash flows, share price, and a range of aspects are well recognised quant factors. Specifically, there is numerous academic literature supporting the statement, stocks which outperform peers on 3 to 12 month period tend to perform well into the future. Clearly, stocks with strong price momentum are rarely value bargains, though plenty of people have grown their wealth by carefully executing this strategy. Now for the value investors, I want to talk about assumptions and error. To reach a valuation, you need to make numerous assumptions in which there is significant scope for mistakes. If your valuation significantly underprices a part of a business, it would be logical to buy the business, though easier to see that in hindsight. One red flag to be on the lookout for would be if you look at a range of valuation metrics, for example, a DCF calculation, but also a peer comparison. And if there is a large range between them, it may be prudent to reevaluate your assumptions and perhaps buy something which is trading above your DCF if you think it's wrong. Finally, one for the maths gurus. I've previously written a blog titled A Distribution of Valuations. In it, I discussed how valuations can be thought of as points on distribution of potential outcomes. In particular, I spoke about the skew of a distribution and how that can affect tail risk. One interesting situation where it could make sense to buy something above your base valuation may be a stock with a strong positive skew. If your base valuation is the mode outcome and the stock is trading between the mode and the median, it makes sense to buy the stock. This is where you can identify limited downside but can obtain a free option to a large upside event. Whilst counterintuitive, there are exceptions to most rules. You may not agree with the 3 proposed scenarios, but sometimes it's worth playing devil's advocate to explore a broader range of possibilities. That's all for this week. Don't forget to follow us on Facebook or Twitter.